An exchange-traded fund, also known as an ETF, is a versatile investment vehicle that can be structured to mirror the performance of various assets, ranging from the price movements of single commodities to a diverse array of securities. Additionally, ETFs can be tailored to follow specific investment strategies. Similar to mutual funds, ETFs must undergo registration with the Securities and Exchange Commission. Upon approval, the fund transforms into an investment company, acquiring and holding assets as outlined in its filing, which are then securitized and sold to investors. ETFs determine the price at which they sell shares, often aiming for affordability. For instance, an ETF may track an American company index with a minimum investment requirement of $1, holding shares of all 107 companies within the index, which may include recognizable names like Costco, Coca-Cola, Walmart, and PepsiCo. Investing $1 in such an ETF would mean owning a corresponding portion of the fund's holdings in these 107 companies. When purchasing shares of an ETF, investors acquire ownership in the fund itself, which holds the underlying assets. ETFs are accessible through various online investing platforms, retirement account providers, and investment apps like Robinhood. Many of these platforms offer commission-free trading, eliminating fees for buying or selling ETFs. However, while trading ETFs may be commission-free, there could still be associated costs imposed by the ETF provider or platform. These platforms differentiate themselves through convenience, services, and product offerings. For example, some investing apps enable ETF purchasing with just a tap, while established brokerages provide extensive educational resources to help investors research and understand ETFs. Advantages of ETFs include their lower average costs compared to individually purchasing all stocks within the ETF portfolio. This cost efficiency is achieved through fewer transactions, resulting in reduced broker commissions, and some brokers even offer no-commission trading on select low-cost ETFs, further cutting costs for investors. The benefit of ETFs lies in their flexibility to include a wide range of investment types, spanning stocks, commodities, bonds, or a blend of these assets. This diversity allows investors to tailor their portfolios according to their risk tolerance, investment goals, and market outlook. Stock ETFs, for instance, offer exposure to a specific industry or sector by comprising a selection of stocks within that domain. Whether it's automotive, foreign stocks, or any other sector, there's likely an ETF available to track its performance. Bond ETFs provide access to various fixed-income securities like corporate bonds or treasuries, offering the benefits of diversification without the constraints of individual bond maturity dates. Commodity ETFs allow investors to gain exposure to commodities like oil and gold without the need to physically hold these assets. This approach not only reduces costs but also eliminates the logistical challenges associated with commodity ownership. Currency ETFs, on the other hand, track the relative value of currencies or baskets of currencies, providing a means for investors to hedge against currency risks or capitalize on currency fluctuations. Industry ETFs narrow their focus even further, concentrating on specific sectors such as energy. By including companies involved in natural gas, oil, renewable energy, and related industries, these ETFs provide targeted exposure to sector-specific trends and opportunities. One notable ETF that has garnered significance this year is Bitcoin, although its classification remains a topic of debate. The Securities and Exchange Commission remains skeptical about the risk associated with crypto, but these ETFs bring some regulatory safeguards and make it much easier to take part in the crypto market. Inverse ETFs offer a unique strategy by seeking to profit from declining markets by shorting stocks or employing other inverse strategies. These ETFs increase in value when the broader market experiences declines, serving as a potential hedge against downturns. Despite their diverse characteristics, all ETFs share common benefits, including access to a broad array of securities, lower expense ratios compared to mutual funds, reduced broker commissions, and risk management through portfolio diversification. This versatility makes ETFs an attractive option for investors seeking flexibility, transparency, and cost efficiency in their investment endeavors.